Good afternoon, a very warm welcome to you all. My name is Pierre Schlosser. I'm the scientific coordinator of the Florence School of Banking and Finance, and it is my pleasure to introduce and moderate today's online seminar on sovereign bond-backed securities in theory and practice. Safe assets are not exactly a new idea. They've been part of the academic debate for some time. The political discussion of safe assets in the European context is the real novelty here. New financial instruments usually do not make the headlines. This one, however, does. In a way, one could claim that safe assets have been actually a product of the crisis, and in particular of the doom loop between banks and sovereigns. As you may know, 2 years ago, the ESRB's General Board commissioned a task force to investigate the practical considerations relating to sovereign bond-backed securities. Upon publication of the report in January 2018, Philip Lane, who chaired the ESRB task force, tried to capture the essence of the safe asset contribution in an analogy that may appeal more than to an audience unfamiliar with the advanced securitization techniques that SBBS rely on. So let me quote Philip Lane extensively in this analogy. He was saying, to see how it works, imagine you're a merchant wanting to stock the best young wines. The provincial approach would be to deal with your nearest vineyard, but the local weather sometimes disappoints. So you would do better by asking vineyards from different areas to club together and provide you with the best wines. In some years, the Loire Valley produces the best grapes, in others they will be tastier from the Rhine. Your customers will be well served, regardless of local weather. Philip Lane goes then on to say that banks are like your wine shop. At present, they buy the local stuff, but they would serve their customers better by obtaining the new securities which protect banks against local disappointments. At the same time, governments, like vineyards, maintain their independence and the associated responsibility. End of the quote, and back to reality. The reality is that not everyone is convinced by the added value of safe assets. Putting politics aside for a moment, safe assets are not unanimously supported among experts, at least in the generic and synthetic version of it. Some, like Wolfgang Münchau in our upcoming ebook at the Florence School of Banking and Finance, claim that they won't work because there is no mutualization involved. Others instead doubt that there will be enough demand for SBBS. These conflicting views bode for great intellectual exchange, I think. So I hope that I've made a convincing case that we have a very relevant topic to discuss today. We also happen to have the relevant experts to engage with the topic, experts from the European Commission who just tabled a proposal on SBBS. So I'm very glad today to be in the company of Peter Grasmann, who is the acting director of the Directorate E on Financial System Surveillance and Crisis Management at DG FISMA. Welcome, Peter. And also in the presence of Davide Lombardo, who is a senior economist at DG FISMA. Their bios are available on our website, so many thanks to you for being with us today. Before telling you more about our participants' profile, I'd like to spend just a few minutes to tell you a bit about our school, and as we have a few activities coming up that could be of interest to you. Most of you know by now that the Florence School of Banking and Finance is a place where multiple generations meet to discuss and argue about cutting-edge topics of financial stability, risk management, as well as banking regulation, supervision, and resolution. You may also know that the school boasts a diversity of policy debate and training activities, and that our online seminars are therefore one of many activities that we hold. If you go on our website, you will find our collection of ebooks, for example, which the UI has produced since 2001, and which focused on the relationship precisely between banking and sovereign dynamics. Our ebooks are available for free. In terms of executive education, we'll be hosting 5 residential courses over the next months that, given your expertise, could be of interest to you. Next week, we'll have a course on credit and market risk management with Jean Dermine from INSEAD. In late September, we'll host a course on liquidity regulation. We'll then have a course in October on macroprudential policy implementation. And in early November, we will look at the more economic aspects of forecasting in economics and finance. In late November, lastly, we'll have the second edition of our autumn school on the law, economics, and practice of banking resolution. Okay, enough about us. Let us talk about you, the audience, sitting or standing in front of your laptop, tablet, or smartphone. You are about 100 participants connected today, following us from everywhere in Europe and the world. 35 nationalities are represented. As always, we have many people from the European Central Bank and the Single Resolution Board represented. So let me say hello to them and thank our colleagues from those two institutions for their loyalty. Then we have a fair diversity of public institutions and central banks also represented. In terms of gender, we have 43% of women and 57% of men. You have almost 8 years of professional experience on average. The thin majority of you are trained economists, but we also have some lawyers and different types of business or social sciences backgrounds. Lastly, 66% of you have a master's degree, while 28% of you have a PhD. I think that's a record. And 6% have a bachelor degree. Right, so it's time to start. But before that, let me just say a few words about how the seminar is going to be structured. So in the first step, Peter and Davide will guide us through what SBBs are and will explain us how the recent Commission proposal can help in facilitating the emergence of SBBS in Europe. There will be then a poll also as part of the presentation. I will just ask Peter and Davide to flag to all of us when they expect us to fill the poll, and the result then of the poll will be discussed during the question and answers session. In a third step, we'll open up the Q&A session where all of you guys will step in. In this context, I'd like to remind our speakers to stick to their speaking time so that we have enough time for the debate. So let me stop here, leave the floor to Peter and Davide. The presentation is already on the platform. So Peter and Davide, can I just ask you please to connect your camera and mic and to share them with the platform?
Thank you very much, Pierre Schlosser, for this kind invitation to speak today and for this excellent introduction, which gives me comfort in two ways. I mean, you explained already the gist of it, which is very good. And you comforted us here with the background of the audience, which is of high caliber, so we don't have to go into, I think, the very basics of explaining some of the concepts which have perhaps driven some decision makings. Davide will speak with you, to you better in a second. He will walk you through the presentation and give a more clearer insight what the Commission just in end of May proposed and what it did not propose. Let me just make a few introductory remarks before that. Just allow me, although I guess most of you know, more generally, where do we stand in fixing the financial system after the big financial and sovereign debt crisis a few years back? I think it is fair to say, I hope I don't just say it because I'm professionally informed, is that we have made a lot of progress. Banks have stabilized themselves, their business models have been overhauled, regulation, supervision have been quite overhauled as well and advanced. We have the banking union in emergence. We have started to build up capital market union, and we have made first inroads into a better EMU architecture. What you also see, of course, is that we are not there yet. Yes, right now in particular, we are seeing the bright side perhaps more clearly, also for cyclical reasons, but clearly problems do remain. Banks do remain in some areas weak. We have NPL problems, we have profitability problems, we have varied challenges to the business model due to new competitive situations, including the fintechs showing up. And we have still the home bias of banks, particularly in some jurisdictions, of their holdings of sovereign debt. Why that is a problem, I don't want to go into that. Maybe Davide will come to that later, but it is clear. More broadly, however, in EMU, we still lack, in our view, an appropriate and sufficient degree of cross-border risk sharing. And there again, the Vineyard were talking to you before. It is risk sharing at various levels. A lot has been discussed and has been focused on over the past year of public sector risk sharing. And we have seen the build-up of ESM, we have seen other forms. But if we, for example, compare ourselves also sort of to other jurisdictions which are more integrated, we also clearly see that the private sector risk sharing has to be the workhorse and is an area where in Europe we are still lagging far behind. And there comes in these SBs, or as we call them now, SBBS. On that front, we see they can make a difference. They can address the home bias. They can improve private sector cross-border risk sharing. That, I think, is the main objective to be seen. Secondly, importantly, also not to be forgotten, by this construction, and particularly by the tranching element, and Davide will go to that later, you can increase the supply of sufficiently safe assets in the financial system, which historically, traditionally have been mostly EU government bonds, but which, of course, the supply of sufficiently safe assets got a hit when the sovereign downgrade spiral started to kick off, particularly after the sovereign debt crisis. Supply going down, demand for safe assets going up. So SBs, in our view, can make a difference. Again, as already was alluded in the introduction, we are modest. It's not, fortunately or unfortunately, the idea of the Commission. We're not that smart. It was academics who first came up with that idea. And the European Systemic Risk Board, in particular, among others, drove further analytical work to see whether that can have any meaningful policy and market relevance in the specific setting of Europe. What the Commission now did in May was to propose to the co-legislators a so-called enabling regulation. That is ambitious and very restricted at the same time. We want to remove or alleviate regulatory obstacles to give them a chance in the market, but do not more. So it's not the Commission or any EU institution which, according to that proposal, would be in the business of issuing or guaranteeing or vetting for these instruments, which are by demotion a private sector solution. Maybe two final remarks before I give it to Davide. We ourselves, I think the European Union, is partly to blame for some confusion in terminology. You also hear somewhere in some texts reference, particularly when it comes to EMU, a reference to a euro area safe asset. That's in a way an unfortunate mix of different terms, both are safe. This euro area safe asset discussion, which you saw, for example, in the reflection paper on EMU of about a year ago, is a different animal. That would indeed be something where the EU would take ownership or would issue something, which is a very different animal, which raises very different problems, although part of the intended problem solution might overlap. So please don't confuse that with each other. Second, final remark from my side. Of course, we have already discussed a lot with stakeholders, all kinds, industry, with academics, with member states. And I do particularly feel from the last group, member states, we face sometimes criticism, which we take serious, and which in my view are partly based on some misunderstanding. And I see two main misunderstandings I sometimes encounter when I participate in such discussions with member states, or partly also others. Number one, again, and Davide will make that clearer, we will not try to make a market for this SBBS. So yes, we don't know if even with that proposal we make, SBBS will have a viable chance to make a dent in European finance. We don't know. This is pretty much what we typically do in our regulatory work as a commission. Yes, we regulate stock markets, we regulate OTC derivatives markets, without being sure, without taking a stake in the development and the flourishing of these markets. The first misunderstanding, what like our devotion is, and number two, it's often then linked to another debate on the so-called regulatory treatment of sovereign exposure, where we have different assertions that it might interfere with that discussion. I firmly believe no. It's neither in the letter of the draft regulation nor in any sort of like discussion behind or any that we see a need or a desire to engage via that into that other discussion, which might be held or not, but which is completely outside the scope of what we discussed today. With that, let me stop here. Let me now give Davide Lombardo the floor, who is the real brain behind that draft regulation, and who will walk you through.
Thank you, Peter. Good morning, everybody. As Peter mentioned, I will go through the presentation. Some of the slides, in effect, have already been talked about by Peter, so in the interest of time, I will skip them. I want to start with giving a very quick overview of the concept of the SBBS, to then dive into the contours of our recent proposal that Peter mentioned was issued in end May. So the main idea behind the SBBS concept is that an entity would put together a portfolio of government bonds with some specific weights that I'll talk about later, and against this portfolio on the liability side issue a series of claims which are ranked according to seniority. So there is a senior claim, senior tranche, which we call the senior SBBS, and then there is a sub-senior part of the liability structure, which economically serves the purpose of acting as a possible shock and loss absorber, so as a protection to the senior claim or the senior tranche. So the idea of the SBBS is that through the pooling of these bonds, which already reduces average risk via diversification, and through the tranching, which basically, as I said, creates in effect a safer claim and a loss absorbing subclaim. The senior SBBS can act as the low risk euro-denominated euro area safe asset that Peter mentioned in his introductory remarks. The important point that needs to be stressed is that this added safety of the senior tranche is obtained not via mutualization of risks across member states, which is, as you may know, something highly controversial and the red line in many quarters, but rather is achieved through the risk sharing among the investors on the liability side. So that's why we see this concept as really helpful and promising in advancing the overall objective of the capital market union also of increasing risk sharing, especially across border among the private sector, as Peter explained. So to go back to the background of our proposal, as was mentioned in the introduction, the ESRB task force has worked for nearly 2 years on analyzing the feasibility and the merits of this new novel concept. And from our perspective here, for the purpose of today's discussion, the main finding of that report, which is fairly comprehensive and extensive, is that the current regulation, the regulation that exists today, hinders the emergence of this new product, the emergence of SBBSs. And that's because the SBBSs would be treated as securitization, and as such would attract a host of securitization-specific surcharges and discounts when it comes to regulatory treatment. And it would also, the investment in such products would also be limited for many important investor classes. And moreover, the products would not qualify for liquidity coverage purposes. This means that when compared to the underlying assets of the SBBS, which are the euro area sovereign bonds, these new instruments will be treated in a regulatory heavier manner. And yet, the issue is that the SBBSs, while nominally being a securitization because of the tranching feature, they do not present many, if not most, of the securitization-specific issues that justify these additional charges or discounts. In particular, there is no asymmetry of information between the issuers of these products and the investors, because for two reasons. First of all, because the composition of the portfolio we will see is in fact regulated, and because the bonds, the underlying assets, which in this case are sovereign bonds, are themselves well known to the investors, and they are themselves traded on the markets, which means that there is a market value that everybody can associate to them. So it is, as I said earlier, the SBBS is a securitization, but a very sui generis one. In particular, it is not a securitization in the sense that it does not securitize assets which are otherwise not traded. The main point here is that the underlying assets are themselves traded. Yeah? So this means that if the regulatory framework imposes charges, but there is no corresponding economic function that the product is actually achieving, then of course the regulation becomes quickly prohibitive and punitive. Therefore, what I say in the last line of this slide, the finding of the SBBSs, the main finding of the ESRB task force, which in a sense put us in motion, is that the SBBSs are presently, in effect, regulated out of the market. So, as Peter explained, we the President Juncker undertook in last September to address this situation, therefore to put forward an enabling framework which in effect would alleviate or eliminate to the extent possible these undue regulatory impediments to the SBBS and level the playing field with the underlying bonds in the SBBSs, which are the euro area sovereign bonds. So let me now, with this long introduction perhaps, let me go into the main elements of our proposal. So the proposal in effect has two big parts. One is the description of the SBBS, the regulatory description. What features would this new product have to have in order to qualify for this label? And then the second part is the actually bespoke treatment that it is proposed that these new products will receive from a regulatory perspective. So as regards the eligibility criteria, as I mentioned earlier, the regulation foresees that the underlying portfolio backing these securities has to be a fixed portfolio of euro area sovereign bonds based on the ECB capital key with little margins around them to make it easier for arrangers to actually gather the necessary bonds. And then there have to be at least 2 tranches. There is a senior tranche, which is very narrowly codified. It's 70% of the overall package. And then there is a sub-senior tranche, which is instead left to the calculations of the arrangers in terms of further specification. So in other words, the sub-senior tranche could be represented by a single element, like a junior tranche, or there might be 2 or more additional tranches, like some mezzanine tranches. It is the regulation foresees some procedures to modify the structure of the underlying portfolio for future issuances in very specified cases. And it foresees that the SPE, the special purpose entity, which in fact issues technically these new securities, is bankruptcy remote in the sense that it is a completely self-standing legal entity that does not hinge on the balance sheet of any other entity. This is to ensure that, from the perspective of the investors, in effect, it would not matter who, in fact, helped the SPE establishment, and therefore who ultimately is behind the particular issuance of an SBBS. There is, the regulation also foresees a framework to ensure compliance with this label. Now, this compliance framework has been basically modeled over the recently agreed simple framework for the simple, transparent, and standardized STS securitizations. The key feature is that it is, if you wish, a decentralized framework whereby it is the SPE, the special purpose entity that produces an SBBS, that certifies in particular to ESMA, that it has followed the methodology foreseen by the regulation. And then only ex post, there is in effect a check of actual compliance, which is performed by the supervisors in the carrying out of their normal supervisory duties. And the credibility of the framework is ensured or is buttressed by sanctions, which are foreseen in case infractions are detected ex post. And finally, what you might say is the last but most meaty part of the regulation, in terms at least of implications, is a section that delineates the bespoke treatment of this new product by introducing surgical modifications in several legislation in the financial acquis. In particular, modifications are introduced in the UCITS directive to eliminate limits, investment limits for these products. In the CRR, this is perhaps the most important because the tranches of these SBBS are in effect equated to government bonds for the purpose of the calculation of capital requirements. And then there are the 2 directives for occupational pension and for insurances, where there are basically calls in the regulation for member states to treat these new products in the same way that they treat in their own national domain sovereign bonds for the purpose of, as I said, insurance and pension funds. And then the regulation also says that there are important changes that will need to be introduced to really equate the playing field between SBBS and sovereign bonds, but this will only be done in a second moment via level 2, changes to level 2 regulations, because this is where these particular requirements are spelled out. The crucial one here being the possibility that the SBBS tranches would be eligible for the purpose of the calculation of the liquidity coverage ratio, as currently all euro area sovereign bonds are. So you can see, therefore, from this very quick overview that our proposal follows quite closely the work that was conducted by the ESRB task force. There are a few differences which I thought would be interesting to highlight. The first one, as I think Peter also hinted at, our regulation is clearly geared towards a private sector product. In the original concept and as well in the ESRB task force report, the possibility is left open that a public entity might actually produce or assemble these new products. But in our regulation, it is quite clear that this is not considered, and that rather the regulation is trying to make sure that if a private sector entity wants to do it, they are enabled to do so. There is also an important difference, which is that our proposed regulation treats all tranches in the same way from the perspective of the regulatory treatment. And in contrast, the ESRB report had recommended a differential treatment for the sub-senior tranches. As I mentioned, we in our proposal we standardize in effect only the senior tranche, which is the putative additional safe asset for the eurozone, while leaving the splitting of the subordinate tranche up to the arrangers, subject to, however, caveats that the junior tranche must be at least must have a thickness of at least 2% to avoid excessive riskiness. And as I mentioned, we are relying on self-attestation on the part of the producers of these new instruments, as opposed to an ex-ante certification by a public entity, which was perhaps the implicit model in the original academic paper. And this is done for practical as well as political reasons. So to conclude this part of our meeting today, I would like to say that from our perspective, SBBS is an interesting concept. It has the potential to improve on the status quo, both in terms of enabling banks to diversify better their government bond holdings, but also in terms of enabling greater risk sharing across borders in the private sector, which is something that, as Peter said, we still, by and large, lack when compared to other more integrated financial jurisdictions. And it can help add to the supply of low-risk assets, euro-denominated low-risk assets. Our proposal, as Peter very clearly explained, is aiming at enabling the development of a private sector-led market for SBBS, but certainly is in no position to guarantee. And there are open questions that remain, on which I have asked the organizer to, in fact, solicit your feedback. So there are many open questions, but I highlighted here 3. Would banks have sufficient incentives to switch their current holdings, which, as I said, are perhaps unduly concentrated in some cases, into SBBS? Would there be sufficient demand for the junior tranche, which is crucial, because, of course, the product can only succeed if sufficient amount of interested investors are identified for the junior, more riskier tranches? And another interesting question is, what would happen if there is, in fact, God forbid, a default of one of the euro area member states? How would this affect not only the existing issuances, but perhaps more importantly, even more unclearly, how would they affect the future issuances? The point is that all these demands, all these questions have been explored at length by the task force, which I also was a member of. And there are many pages that have been produced of analysis, but ultimately the only way to answer them is to allow for a market test for SBBS. So ultimately, only the market can tell us if this interesting theoretical concept is in fact a viable one. And the purpose of our proposal is precisely to enable such a market test that currently is basically impeded by the regulatory hindrances that I discussed earlier. And with that, I would ask you to, I see that the poll has just been closed. I am looking forward to hearing your views as to what would be the biggest obstacles to the success of SBBS, assuming that this proposal is favorably treated also by the other co-legislators. Thank you very much.
Thank you very much, Davide. Thank you, Peter, for the very good overview. I think it was very informative in nominating. And let me now invite all of you to focus on the chat box to share your views, your thoughts, or indeed your direct questions to our speakers. As always, if we have many contributions, we will try to regroup them. I see that several of you are typing right now. You can see the results, Davide, on the chat box of the poll. So would you like to go through them and briefly interpret them?
Yes, I will read them for the benefit of Peter, who's still sitting in the room, though you cannot see him. So our audience sees the biggest obstacles as in effect being insufficient incentive for banks to switch from national bonds to SBBSs, almost 60% to 58%. And then in second position, we have the insufficient demand for riskier tranches, which is basically 30% have come with this conclusion. And the remaining 13% actually points more to the costs associated with setting up the SPE and servicing instruments. And this is a very interesting result. I'd say it's quite consistent with what we heard in our previous interactions with the audiences of stakeholders, in particular with audience of informed stakeholders. And now I am looking at the questions that are coming up.
Let's maybe start from the beginning with Pavel's question, if that's okay. I mean, either Peter or you.
Yes, Pavel is asking, what would be the risk weights for the different tranches? So as I perhaps went very quickly over it, but as I mentioned, the idea is to level the playing field with euro area sovereign bonds. Currently, all euro area sovereign bonds attract at zero risk weight for the purpose of capital requirements in, at least for the banks, for CRR purposes. So the idea would be that the proposal is for all tranches to have also zero risk weights for the purpose of capital requirements. And just to add quickly to addressing the second question, how would I make sure that the SBBS receives the same treatment? Well, that's easy, because that's what's written in the regulation. So the regulation says that if these new instruments in fact are created for the purpose of CRR, for example, which is the banks, they would receive the same risk weight as government bonds. Yes.
Let me just perhaps, there were a couple of questions on the issue of the risk weight on the junior tranche. Indeed, as Davide explained, we propose the same zero risk weight as for senior ones, and for example, contrary to what the ESRB suggests. Why do we do that? Isn't the junior tranche more risky? Yes and no. I mean, yes, by definition, the junior tranche takes the first loss very clearly and makes therefore the senior one more safe. At the same time, we start from the situation that the underlying pool of assets would constitute euro area sovereign bonds. And as you know, the current prudential regulation in the EU at large considers for regulatory purposes all EU bonds as safe, zero risk weight. Regardless of the fact, of course, that markets see differently, that there are risk markups, risk spreads, CDS spreads on government bonds, which are sometimes higher, sometimes lower over time, and which vary considerably among member states. Indeed, we know that. Therefore, from there starts what I already mentioned, the discussion on the so-called regular treatment of sovereign exposure. That discussion might be held or not, under conditions or not. This is not up to me to judge. Only we didn't find it appropriate to change now the basic structure of Europe via the backdoor of the SBBS. It's if all the underlying assets, regardless what markets think about it, as long as they apply zero risk weight, enabling regulation should allow for that as well. May I perhaps want to add also, like we started from the premise or from the finding of the ESRB that the current regulatory treatment of SBBS would constitute a very effective hindrance to the development of markets. Now, if we would adjust level playing field to level playing field the senior bonds, but not the junior bonds, what would that mean for an arranger, for an issuer, which has to be able to issue both the senior and the junior tranches? But the junior tranche is still basically lacking the competitive advantage, or any competitively hindered by the regulatory wedge. That would also be then basically hindering the issuance of senior bonds. So in that way, it would not be an enabling but a disabling regulation.
Thank you. So there are several questions lined up.
Yes.
Very active debate. There was one question on the governing laws, a question by a lawyer, Katarina Bergan, who is asking, what governing law would SBBS have? Would you not risk creating 19 different types of SBBs with very different securities law governing them? Is that a consideration you had while preparing either the proposal or the SRB report?
I don't know. I mean, there are, as a general objective, I could have made it clearer in the presentation. Indeed, we want the SBBSs to be as standardized as possible. That also is why we have this, in a sense, top-down approach where we dictate up to some margins, for example, the portfolio of the weights of the underlying portfolio. Now, we are aware that nevertheless, because we don't micromanage the product to the extreme, and we stop far short of it, there may be some differences across issuances of SBBSs, so therefore across, if you wish, vintages of SBBSs. I'm not quite sure that the law, the governing law would be a particularly important one. It might be, but I would imagine there is something relatively will be quickly addressed by the private sector, to the extent that it might be a quick convergence on any particular governing law, to the extent that they differ, which I am not aware. That is more conducive to the success of the product. But certainly there will still be some differences among the issuances, in particular over time. We are aware of that. We found that this was basically unavoidable with the private sector product.
Okay.
But that's why. But at least our hope is that the differences would emerge mostly on the junior and senior tranches, and not so much on the senior tranche, which is quite strictly regulated in the proposal.
Okay, thanks. There were two more questions, for example, from Christoph and Tina. If you can have a look. The first was on the justification of equal preferential treatment of all tranches. And then the second one.
Yes, so the first one, I think Peter addressed it. Second one is, who will be the investors? Well, I guess the question is, who will be the investors of the sub-senior tranches? I mean, for the senior tranches, we would like to think that the banks are a natural a natural class. Not only them, pension funds, perhaps insurances. But for the sub-senior tranche, of course, it would depend very much on how they will be structured. But our sense, talking with the market participants, is that there is quite a bit of pent-up demand for relatively riskier, therefore higher yield securities, especially among such investor classes, some asset managers, but mostly hedge funds in particular, who incidentally are not subject to the capital requirements regulation. So to the extent that also, you know, this is mostly for the junior tranches, but for example, there may be some pension funds or some insurance companies that have an interest in lifting their expected returns, especially given the current backdrop of very low or even negative safe interest rates. And they might, for example, be more natural candidates to purchase, say, middle of the ground mezzanine securities. Mm-hmm. And then what was the other question, Pierre?
Then there was a question by Tina about the 0% risk weight for junior tranches. So I think that in some way we have covered too, unless you would like to
this goes back to the point that I think Peter.
And then Michael comes up with a question on the incentive for banks to shift from a safe sovereign bond to an SBB. So the more micro incentives.
That's I guess, from memory, this is in fact an expression of the general question that came out from the poll, right? 60% of the audience felt that's the biggest question. Well, you know, these securities are more diversified, better diversified. So in some sense, prudence might be one source of the demand for these, one element of the considerations that the banks may make. There's also, to some extent, an element of network and non-linearities. I mean, banks might want to switch into these products to the extent that the other banks are switching. In a sense, it depends. It will depend a lot on the degree to which these new products are in fact seen as liquid and, you know, benchmark instruments to invest in. But it's true that, strictly speaking, the regulation per se, and this is by design, does not twist banks into investing into these products. The objective of the regulation is to make banks effectively indifferent. Now, it remains to be seen whether the indifference could be, in fact, resolved in the direction of the SBBS. And as I say, it might be also a matter of what the others will do. So there may be multiple equilibria in some sense. Multiple outcomes are quite possible. And success would breed success in this case. That's what I mean.
A question about the targeted maturity of the SBS and how the maturity would impact the composition of the SBBs by Armanda or Amans.
Yes. The regulation is quite silent on that. It just says that the arranger, the private arranger, needs to put together underlying bonds which are unavoidably different in terms of maturities, but not too different from each other, because the point of the differences in maturities is that it generates a period whereby this SPE or the special purpose entity would receive basically payments from some of the bonds, but not from the others. And until the SPE closes, in effect, the contract, it will need to reinvest these proceeds, and so therefore this is an element of variation or heterogeneity across the SBB issuances, which we alluded to earlier. But aside from that limitation, the regulation is basically designed in a way that is neutral to the maturity of SBBSs. we would imagine that if the SBBS come to be produced, they would be produced first and foremost in the most standard maturities, maybe 5 years, 10 years, the tenure of 5 or 10 years, depending on the market demand. All of this is left for the market to basically determine.
Okay. Another question by Tina, unless you or Peter wanted to pick up on something else so far.
You mean the last question on the banks? Like, do you expect negative side effects? Yes. I mean, as I said, and as we discussed, it would to the extent that banks focus on the senior tranche, this really adds to the safety of the system. If the bank, on contrary, if the banks were to exclusively focus on the junior tranche, then that's less so. But we would expect that to be something that is controlled and monitored also by the supervisors. So the regulation does not immediately constrain that aspect, but I guess would be something that would be looked in very closely by supervisors in their discussions with the banks.
Okay, a question that didn't come up, so yes. May I ask?
So the second point, Julian is making the same point, to the extent, in a sense, if perhaps at the risk of repeating what Peter said earlier, we have today the situation where all the government bonds have zero risk weights, but yet they have different expected returns because in the eyes of the market they have different riskiness, and yet we don't see banks piling on the corner solution where they all buy the bonds with the higher return, higher expected return. So in some sense, the observation suggests that risk weights are one element in banks' choice of their portfolios, but it's not the only one, certainly.
Okay, before going into the French-German question, because there was also another comment on that, so perhaps we will conclude on this note afterwards. I wanted to ask you about the repercussions on the, let's look at it from the ECB side. How would SBBs be treated as part of the ECB collateral policy? I mean, would there be any difference compared to sovereign bonds? Have you done some analysis on that?
Well, right now the situation is such that the SBBS would not be acceptable under the collateral framework of the ECB. The collateral framework of the ECB lists in a positive manner what is acceptable and what is the appropriate discount that would be imposed in case of use of these of the various securities for the purpose of, for example, liquidity operations. But as you well know, the ECB is independent, so the regulation does not in any way propose or even impose or recommend any action on the ECB. But certainly, one thing that I would say is that you touched an important point, and in our interactions with the market participants, this is something that has come up a few times, so that ultimately there is an important reason why banks actually hold government bonds, because they can use them to interact and access ECB liquidity. So in some sense, this would remain an element of divergence.
Okay.
That might want to be addressed.
Okay, very nice.
There
are a few more questions. Again, let's park maybe the French-German question to the end and focus first on Lorenzo's and Michaela's question.
Yes, Pierre, I see there is one question at the end. The last question by Michaela, if I pronounce correctly the name. She's asking about how the liquidity of the senior tranche can be guaranteed in a crisis situation. So this is a point that comes up a few times. So what would happen to these products if there were a crisis? Let me say the intended way that these products are meant to work is that if there is a crisis situation, a financial turbulence, people would move out of the junior tranche and would, in fact, buy the senior tranche, which is constructed to be safe even in rather extreme circumstances. So we actually would expect that the senior tranche would become even more valuable in a crisis circumstance than it is normally, just because in a crisis circumstance there is an enhanced demand for safety. And the point of the SBBS is that this enhanced demand for safety would create, if you wish, pressures along the junior versus senior dimension, but would not create additional pressures across national borders. So the people would basically dump periphery bonds to pile up on core bonds. Because that in itself creates additional issues for the tenure of the euro as a single currency. It's true that if there is a major crisis, then the junior tranche becomes particularly risky. So when you think about further issuances of SBBS into a crisis, then the junior tranche at that point is quite risky, because the likelihood that any single euro area government might get into troubles is quite high in that circumstance. So we cannot rule out that, in fact, in a major crisis, there will be no demand for the junior tranche. And so the issuance of SBBS might have to take a pause. But that's not to say that it will not happen already for some government bonds. Some government bonds in the crisis situation are effectively priced out of the markets. And also it does not mean that the SBBS that would have been already issued until that point would not in themselves act as a stabilizing force, so as to reduce and alleviate the implications of this crisis. But it is true, I think it's fair to recognize that since this is a private sector instrument, the private sector might not be in a position to guarantee continued issuance in and out of a crisis situation.
Thank you.
Yes, and I think that Michaela is making this point. So if the junior tranche shuts down, well, I don't know if it would impair the liquidity of the existing SBB senior. I think, actually, as I say, I would expect the senior to be quite popular in those moments, but it may very well impede the capacity of issuing more senior, to adding to the stock.
Okay, I think we have time for two last questions. The political one, let's say, to end up with would be the French-German question on the political feasibility, let's say. The other one...
the question for Peter.
Exactly. So that's why I would give you the chance to take one of the last technical ones, let's say, to simplify. I mean, either the one by Catarina or Lorenzo, and then we move back to politics.
Catarina is asking... Okay, Catarina is asking the rationale of recognizing losses immediately. She's touching an important point. So this product is particular because we are trying to carve out from the senior tranche a low risk asset for the Eurozone. So it would be important to ensure that the senior tranche is in fact treated as such, not only in a static manner, but also in a dynamic manner, in the sense that you would not want to have the situation where you pay both tranches all along, and then only to find out at the end of the life of the instrument that in fact you cannot pay the last big payment on the senior tranche fully because, say, one of two governments have in fact defaulted or restructured on their debts. I mean, these are, as we talk, you can imagine these are very extreme circumstances. But nevertheless, conceptually, the point about that very technical Article 6.6 is to basically restrict the waterfall that can be specified in the contracts on which the SBBS will be basically issued, that the senior tranche should really be senior. I mean, should really that you need to come up with a procedure whereby if you pay at any given point in time out for debt service, the junior tranches, you have a very high likelihood that in fact there will be no problems down the line for the senior tranche. But it is a very technical point, and I'm glad that Caterina spotted.
So. Okay. Yes.
Maybe Peter is coming in to ask the Franco-German question, as you called it. 1 second.
Just to say the obvious, of course, I was not in the meeting, and of course, I'm not authorized to speculate on the motives behind this view taken. But clearly, I do think everybody agrees, every member state, we agree that we have to strengthen the euro area. We have to strengthen it by various means, by risk reduction measures in the financial sector, probably also in the non-financial sector, by more public sector risk sharing, and by more private sector risk sharing. In private sector, you can see there are sort of kind of mandatory possible forms. EDIS might be a way, and market-driven ones. And in our view, we need them all. And our proposal on SBBS, of course, goes into the latter. Of course, you can take the view that, but I'm completely speculating, that if the other mechanisms are strong enough, for whatever reason, that you can also strengthen the euro area without further deepening now also the banking-driven private sector risk sharing. Having said that, of course, I'm very happy that also the German-French declaration came up with a clear endorsement of capital markets union, which is a way, another strand of exactly doing that, to do the private sector, the integration, the risk sharing, to alleviate the pressure on other mechanisms which proved politically so difficult over the past years. Thank you.
Thank you, Peter. This seminar is now about to end. I hope you enjoyed the intellectual remote stimulation. I'd like to warmly thank our speakers for their time and dedication in preparing this event, and all of you for your questions and for watching us.